Hello, how are you doing? Welcome along to our FTUK live stream. It's Friday the 22nd of November and it's getting pretty cold. I got to admit, absolutely freezing. I hope you are warmer wherever you are and I hope you've had a good week in the markets. Fascinating time at FTUK, and as always in the live stream, absolutely packed with tons of information that we need to get through. But obviously, before we do start talking about that, don't forget to check out our Discord. If you are not part of our Discord community, I say it every single week, scan the QR code that you can see on the screen there. Go and speak to our lovely moderator, Reza, who will sort you out in Discord. And yes, it's a good thing to be involved with FTUK at the moment because there's so much happening this week on the live stream. We are going to be talking about three key topics. The first up is we're going to be looking at the two-step evaluation. We always assume that everybody knows what the key advantages are in a two-step, but you know, it's not a bad thing to just recap and have a look at some of the comparisons between a one-step and a two-step and why you might want to consider using a two-step. I also want to look at talking about the competition that's just finished. The Profit Chasers finished a couple of days ago. The winners have been announced and the prizes have started to go out. So we'll do a quick update on that. And also as well, we are moving into a theme of technical analysis as well. So we're going to do a deep dive into the relative strength index, the RSI indicator. And this is an indicator I know a lot about, and I think it's underserved online as well in terms of an informational kind of point of view that can be put across to most traders. It's very, very sparse information. It looks good, but there's a lot more under the surface when you start to scratch away at it. So let's start by talking about a two-step evaluation. If you're new to prop trading, or if you're new to FTUK and you've never seen a two-step evaluation before, they can be considered to be a little bit confusing, but they're not that complicated when you really understand the gateway into how prop trading works. And it's a two-step has a very, very, very valid place in the model of being a prop trader. And I think that it's something that you can benefit a lot from. They tend to turn out better traders. And the key thing is that it really teaches you about patience. It's something that you need to be patient with if you decide to go down the route of a two-step. And you get more for your money and you get a lower price, but it's that patience that you really, really need. So how does this differ and how does it start? Well, let's go back to basics and let's think about exactly how a prop model works. It's very, very simple. You'll hear the word challenge, evaluation, verification. It's basically a test. You're going to buy an account with a certain amount of money and the prop firm is going to make you do a trading test. We want to see how you trade, how you manage your risk, how you perform over a certain period of time, following a certain number of rules, and then if you're good, if you pass the test without breaking in the rules, you get a funded account, you get to withdraw profits and stuff or scale, however it is you decide to do it. That's it. That's how a prop firm works. Okay. Most prop firms, the basic model was that you do a test and then you pass that test and then away you go. Okay, a two-step evaluation is very, very similar, except there's two tests rather than one. So instead of just doing one, passing, and then, scaling or taking profit out, you're going to be asked to do a second test. Now, why is that so important? Well, you've got to think of it from a risk point of view. It's very, very easy. Well, it's actually not very easy, but it can be quite common for people to pass a one step and they just happen to just be in the right market at the right time. It's a lot harder to replicate that if you have to repeat that process for a second time. And that's what a two-step is basically designed to do. Now, there's some advantages to working like that, which I'm going to highlight now. So you do one test, you do a second test, and then that is where you pass from. And usually with most two-steps, the rules change from one test to the second. It's really more of a checking mechanism, that second test. And that's why you'll find a lot of two-step evaluations are labeled as a challenge or an evaluation. And then the second component of that is called a verification or a phase 2. That's usually how they call it. But it's all meaning the same. It's a second test. So let's have a look at how we do things at FTUK, because obviously different prop firms do things in different ways. At FTUK, this is a comparison table between our one-step and our two-step. And you can see I've just pulled out 4 key metrics there for you to have a look at. The minimum trading days of a one-step, they are 4 days. You have to have a minimum of 4 days trading. But for the two-step, it's only 3. So what you'll find the comparison between one steps and two steps is what you get with one, you'll get something different with another, and that balances out. Yeah. So it depends how you decide that you actually want to work. With a one step, you'll get a trailing drawdown, and that'll be set at 8%. But with a two-step, you'll get more room, and it's also static. So you see there's a difference between the two. And what that does is it starts to give you more scope on the account. It allows you to be patient. It allows you a smoother journey into it. That second step as well, you get a static drawdown again, but it's 5%. And what they do is we narrow that because it's a verification level. Scaling target, again, similar type of thing. With the one step, it's at FTUK, it's a 10%. That's where we require people to get to, and that is very, very similar test in the first component of the two step, but that again changes in the verification level. It doesn't need to be as aggressive because it is just a check. And finally, the final component of that is the drawdown. You'll see there that you only get a 4% daily drawdown with a one step, but that is extended out on the two-step, and you get an extra 1%. It doesn't sound much, but when you're trading actively on a day-to-day basis, those kind of extra bits of room on the parameters of the rules, they really, really make a difference. So it is important. Now, let's look at some of the key advantages of why you might want to work with a two-step. And there are a number. The first one is that it's a smoother journey. It is a smoother journey. You have more time, you have to be more patient, but as a result of that, there's less pressure. And the test is not giving you any pressure, it's just a continuation before you're getting that funded account at the end of it. So it is a much smoother journey into a funded account. It also, what it tends to do as a result of that is it tends to produce better traders, because we're checking the trader twice. If you're passing both of those components, both of those tests, it's much more likely that you're not relying on luck. Yeah, and therefore you're working in a way that is repeatable in the market, and your trading performance will therefore be more accurate. So it does tend to produce better traders. And there's also some fantastic other advantages of being that, of working like that, and that is primarily because you will have better trading conditions, as you could see from the table that we just looked at. You will get more room on the parameters, and that in itself makes the journey a lot more smoother, and the trading conditions are much more in the favor of the trader as well. And probably the biggest reason why, and this is one of the reasons why I really love two steps, because I'm a big fan of access. That nobody should be excluded from the journey of learning how to trade in markets. I think it should be accessible to everybody, and it shouldn't be an elitist thing like it certainly was, tens of years ago. And the thing with a two-step is they're incredibly cost-effective, really cost-effective. They're a very cheap gateway into getting into props. So if you're limited on your budget, you're not restricted. That in itself is an absolute game changer. So the place for two steps in the market today is a very, very valid place, and there's a really good use case for them in there. So you don't need as much capital to actually get involved. So in comparison to the one step, I am a big fan of two steps just by that factor. So what we've done is we've put together a great offer this weekend for all of our people that are interested in trading a two-step evaluation. It's a $99 discount, a full $99 off our top tier two-step accounts. That's a 50k account and also a 100k account. So what that is basically essentially doing, and this is why it is such an amazing way of getting involved in prop, it gives you access to $50,000 if you can go through the steps. It gives you access to $50,000 for just $169. And for a $100,000 account, you get access to that for just $400 with the discount. That's absolutely amazing. And all you really need to do is just settle down and work within that structure. And if you're good and you can repeat it, it's a beautiful, easy, smooth gateway into working with a prop firm. All you need to do is head over to the website and select the 50K or the 100K two-step account and use this code. You'll see it'll go out on the emails and all that type of thing as we normally regularly would do. But you can see it there, $2.99. That'll give you access to the two-step. They are an amazing gateway, and I'm a massive fan of allowing people on all budgets access to learning to trade, getting better at their trading, and having a decent chance of withdrawing money as well. And the two-step definitely allows that. Okay, let's move on and let's talk about the Profit Chasers. This is our first competition that ended a couple of days ago, and wow, was it popular. Massively oversubscribed, and I am so sorry to all of those people. There was at least 4 people that had emailed me saying that they couldn't get involved and they were disappointed, and I said, okay, don't worry, we will get you at the front of the queue for the next one. But it was very popular, and thank you to everybody that took part. We did have some cheaters that were trying to cheat, and we have managed to sort of sort all of that out. But the winners have been announced, and those prizes have started to go out. So if you want to check out where you placed on the leaderboard, then all you need to do is head over to the dashboard. Whoops, let me just bring up the right thing so you can see it. There you go. So this is the dashboard in the on the FTUK website. You can see the competition there in front of you. And you can see all of the winners. David was our top guy from Nigeria. Got $1,000 wired to him yesterday. And congratulations to him. Now, you will be placed on here. There's no question about that. And all of the prizes will have gone out. Now, David, I messaged him. I said, congratulations. We've never done a competition before. I messaged him and said, would you mind, could we have a chat with you? We'd love to hear your story and love to understand exactly how you went about it, because he did an amazing performance in 7 days. And he says, yeah, sure, no problem. So thankfully, he agreed to an interview yesterday, and we're going to put it on YouTube next week when it's all been edited and all polished up. But I couldn't resist getting the first bit of it clipped together, and I'm going to play it for you now. This is David from Nigeria, and he's won the first place in our first Profit Chasers competition. Have a quick listen to this. David, congratulations. Fantastic performance. $20,223.80 gave you the first spot in the competition. That's a 20% gain on the account in 7 days. A win ratio of 59% as well. Congratulations. How did you do it?
Thank you very much, Nick. Well, I just traded. Let me say I just applied the concepts I've learned over the years, and I saw myself at the top. And I just thank God first and foremost, and thank my mentor as well for the opportunity to make it this far in the contest. Yeah.
Wow. Yeah, really, really amazing. Were you keeping your eye on the leaderboard moment to moment? Because I had my eye on it occasionally, and I saw you were in the lead, and then you dropped down a bit, and then you lead again.
Yes,
so were
yes.
you nervous about maybe getting the top spot in the end?
Well, not really nervous, but I was just watching. I was watching every other person on the leaderboard because I had to know what I was up and who I was up against. You understand? I saw some people. I saw that some people were not as aggressive as some others. Some were very, very aggressive. Yeah. So that kind of informed my decision as in part-time as to how I will engage the markets. And also it helped me know the kind of pairs I would trade, because I had to go for something that would give me the gains that I needed.
Yeah.
Something volatile.
Yeah, very much. I want to talk about your choice of currencies as well, and your trading instruments. I mean, you've gone for gold, the dollar against the yen, the pound against the yen, the dragon, and also as well the DAX as well. I mean, these are historically very volatile markets, so they're quite thin markets as well. And as soon as I saw that, I thought, oh, that's quite a deliberate choice. So just tell me a little bit about why you decided to work like that and how that connects with your trading style.
Yeah, it's part of it is what I mentioned earlier, because it's a competition. It's not like it's something like it's a competition basically. So I have to use volatile pairs because I need to. There's a target to meet, and it's like we're in a race. So I can't trade something that's not as volatile as the pairs I chose, because it wouldn't give me the gains. Even if I took the same setup, I wouldn't get the same amount of profit if I were to have chosen something that was less volatile. So that's why I went for gold. And apart from that, those are my pairs. Like those are the pairs I trade like off for like gold and DAX. The DAX. Though I didn't do much of the DAX because the DAX market wasn't really given. So I concentrated on gold. And the flip side of gold is actually UJ. So that's just how I went about it.
Yeah, a really interesting guy. What I like about the way that David was so competitive with the competition as well, he was tailoring his approach, his style, his time frame, and his asset classes to fit the kind of competitive element that he was looking for to get himself up the leaderboard. So he obviously clearly thought about it in great detail before getting involved and executed with precision. He's a really interesting guy. His story is fascinating and his trading style is fascinating as well. So we're going to get the interview cut together in full and get that on the YouTube channel next week for you. So so make sure you keep like and subscribe to the YouTube channel as always with these things so that you can you'll be able to get a notification when that is going to happen. Yeah, really, really good to see. Now, this is going to be the next competition that we've got coming up that you can see in front of you. So if you didn't happen to get involved in the last one, do not worry. This one is going to be the next one. It's going to be called, well, we're moving to that time of year. So this is called the Festive Fortunes. The prizes have not been allocated yet, but trust me, they're going to be good. They are going to be good. So if you look at the link in the description section of the video, you will see this link and it'll take you to this page. So if you do want to get involved, then the registration is not open yet, but it will be in a few days time and you'll get that notification of when it starts. Now we are going to limit this. It's not going to be 250 people. It is going to be 100 people, and we've got some people that we promised that we would get them involved because they were desperate to get involved in the last one. So they are going to be in there as well. But if you do want to get a heads up of when the registration starts, then all you need to do is fill your email address in there, hit sign me up. I will put you in the list, and then as soon as we are good to go, you will get the message wired out to you straight away. It's going to be a good one. It's going to be longer than 1 week. It's going to run all the way through December, so it'll it's a good way to start 2025. Put it that way, or it could certainly pay for your Christmas if you get it right. But there's a few tips from David in that interview as well, which are worth listening to. So. Yeah, it's good stuff. I think the competitions are good. I'm really enjoying it. And it was good to see so many people take part as well. Gosh, right. Okay, let's move on and let's talk about technical analysis. Wow, we did fundamentals a few weeks ago, as I mentioned in last week's live stream, and we're going to be focusing on technicals over the next month or so. And this is a big subject. And one of the things that we thought we would maybe start with, we'll do more educational content around various aspects of technical analysis. It's a massively important component to all retail traders, whether you're just a regular trader with a brokerage account or you're a prop trader. It's how everybody slices and dices the market so they can make an informed decision. It's how people work. But it's surprising how few people really understand a lot of the tools. And there's an inherent quality of having the tech providers give you these tools all the time, which it doesn't necessarily make people lazy because they'll still work hard at it, but what it does is it makes them summarize their journey in learning some of this stuff, and you miss out on a lot of the rich detail. A lot of indicators are victim to that kind of mentality, and it's a shame because it means that so many people, they end up sort of trying to use an indicator and ditching it. And I'm a big fan of going right to the bottom. So what I've done is I've put together some information about the RSI, which I believe you're going to really struggle to find in other places. So let's go through this stage by stage. If you've never used RSI, it's cool. It's one of the key. It's like the Photoshop of indicators. It really is a big thing. So it's worth definitely paying attention to these kind of ideas that I'm going to present. So RSI, most people who are watching this who've got some experience in it, they will be very familiar with the classic way of using it, and that is that RSI is considered a momentum indicator and it's divergence. You see a sequence of higher highs like that you can see on the chart there, and you see a sequence of lower highs in the indicator once we're above 70, and people say, okay, that's it. That's the strongest component of RSI, and that is it. No more, no less. That is your sell signal. That is your buy signal. Obviously, the reverse for a bullish market that's now turning bullish, but you can see it. Divergence, convergence, See, the price action is going up and the RSI is then starting to fail to mirror that kind of progress. That's it. And this is how the industry sells RSI to most retail traders. What it basically does is it says that the RSI is a momentum indicator. Check, true, it really is. And all you really need to understand is that over 70, the market is considered to be overbought. And that means you should then sell the long position you've got, or you should look to consider shorting the market. Or alternatively, under 30, the market is oversold. And therefore, you should be looking to buy back your shorts, or you should be looking to get involved on the long side of the market. And that's it. Trade the divergences. If you go onto YouTube and you look at RSI videos, you'll see that the majority of RSI content that's online goes no further than this. Now, this is a massive problem. RSI is a phenomenal tool, but you've got to scratch under the surface. And I really don't understand why a lot of YouTube content doesn't give you more than just that basic frame. It's possibly because a lot of people, they just want a summary. They don't really want to understand the intricate details. They just want to reduce everything down to a buy or a sell signal. Don't tell me how it works. Just tell me when to click the button. And that's possibly why. And it's such a shame because you really get a lot of benefit as a trader, and it will help your trading, your strategy, and your execution if you really understand how the indicator is working. It's such a shame more people don't spend that extra time, and it's not a lot of work. This is the strange thing. So I've put all that information together here. Don't just boil RSI or any indicator for that matter just to a basic decision. There's much more that can be understood from how it is working. So I put together a list of key insights. Now, obviously, we've got, it shows tops over 70 and shows bottoms under 30. That's a given, and most people will be familiar with that, as they will be with the second point on this slide here, and that is that RSI is considered useful when it's in a state of divergence from the price action, and that is the strongest signal. And it's true, it is the strongest component of RSI, but it's not the only one. And you can use it in multiple ways. For example, you can use the RSI to basically show you a chart formation. So a chart pattern that you would normally consider on the price action, if it's not particularly clear, sometimes RSI will show you with a lot more clarity because of the way that it's measuring momentum. Who knew that? It's amazing. It works really, really well when you know what you're looking for. You can use it to understand how a failure in the swing in the RSI can be a great indication of a reversal in the market, particularly when you're at those extremes. So that is when you can then start turning it into a buy or a sell signal. You can also use it to forecast clear areas of support or resistance and when those areas of support and resistance are going to fail. It does that particularly well as well once you know what you're looking for. And finally, you can actually use it as an indicator of when momentum itself is so strong that you should do the one thing that most traders find most difficult, and that is stay out. So you imagine you've got a move that's moving up and up and up, and you're selling tops and buying bottoms. So you're just a counter trend trader, and you're shorting the top constantly, and that then just eats away at all of the profits that you made over the course of the week. RSI can tell you, don't do that. It's not worth it on this occasion. That's a massive, massive advantage as a trader. It really is. What you've got to do is you've got to understand momentum. That is really the heart of understanding how to maximize an RSI. So we're going to go right back to the beginning, and this is a diagram of how a momentum oscillator, and you will get lots of different oscillators that will be measuring momentum, but this is the core principle of how momentum is measured in the format of an oscillator on a chart. You can see here in front of you, you've got the price at the top here, and you've got the momentum oscillator at the bottom. And what that is measuring is the rate of change. So I want you to imagine, like in this move here, that you are moving at the same increment in each time period. That is and once that starts to be the same amount, you're measuring the rate at which you are changing. And in the case of an RSI, you're doing it over 14 periods. That is what that is actually measuring, the rate of change. That is how we gauge momentum. So when the price starts to move in a very strong directional move like this is moving to the downside, what you'll find is that the rate of change is even. It's consistently the same. And that's where the RSI, the momentum element in the oscillator, tends to be relatively flat. Okay, just hold that thought for a second, because when you get the turning point, so you see that the price action starts to bottom out and starts to turn, what happens to the oscillator is that once prices has reached an extreme, it starts to turn back up. Why? Because the rate of change from the inputs that have created the indicator start to reduce really dramatically. And what that does is it really pushes the indicator up very, very aggressively. That is how you know that momentum is starting to shift. And that's why this concept is used to actually measure turning points in momentum, and it does a very, very good job of that. Now, this is just a diagram, but you've got to imagine that you maybe have little undulations within that move. But the point is that the momentum, the rate of change in the momentum indicator, is showing you that shift, and that helps you isolate the bottoms and the tops of moves. Now, you then move back to the second state, to the first state, and that is that once the periodicity of the indicator has started to even out again, and your move is very directional, that rate of change will start to narrow, and the indicator will flatten out again. And that's basically where we get this concept, this bottom and topping, where we get this concept of 70 and 30, overbought at 70, oversold at 30. That's basically why, because you're having that flattening effect at either side. And finally, as well, when price then starts to move in a sideways direction itself, the third state is basically the rate of change again starts to narrow, and then momentum starts to drop off, and you'll see the indicator start to ease off and move to the downside. That is basically it. That's the core of how the RSI is working. Now, we're not going to do a deep dive into the actual the equation that makes up the RSI, because that's just a very simple way of looking at it. But the point is that once you understand how momentum is measured and what the indicator is showing you, you'll be able to see the market. You'll be able to use the RSI in more of a way that's less binary. Yeah, so it's not just a buy or a sell signal above 70 or below 30. You'll be able to then pick out all of this extra detail that I was talking about. So let's go through each of those extra concepts. Obviously, you've got that first concept, that the indicator itself will show you tops and bottoms in the market, and it does that pretty well. That in itself, you try and trade that, it's very, very difficult. I've never really seen anyone that's able to turn that into a massively consistent system. You get oversold down here under 30, and you did get a bottom, and you got overbought here at 70, and you did get a top with a flush to the upside before you move to the downside. That is definitely something you'll see all of the charts, but trading that in itself, it's not a particularly easy thing to do. The second one is that it will help you solidify when we are in a state where we're starting to form a chart pattern. Now, chart patterns always tend to form around support and resistance, technical chart patterns, but then sometimes they can be not particularly easy to spot. So this is a good example here of how the RSI helps us gauge a potential chart pattern, a consolidation in the price action, where it's a little bit trickier to see it in the actual price action itself. So if you look at this as a daily chart of the euro dollar, you can see the beautiful strong trend that we've got there day after day after day. Then we move into a channel, but we are getting a sort of a wedge type structure, which would be a turning point in an uptrend like that, but it's not particularly clear. But we get a sort of a pennant structure in the RSI indicator itself, and that is clear. So you can see how the indicator itself is giving us a heads up on a potential chart pattern forming, which is a lot harder to isolate in the price action itself. So many people don't use the RSI in that capacity, and yes, would you believe it, you are actually allowed to draw trend lines on your indicators. Trend lines are not just reserved for the price action itself. You can use them for drawing lines on your indicators. Very, very valuable, and so many people don't even bother doing it. You go onto a forum and you look at people's charts. Very few people actually put those trend lines and use those support and resistance points, those inflection points, as useful information on their charts. They all usually just reserve all that drawing stuff for the price action itself. You don't need to. Next one is, this is probably my favorite. This is where we can actually turn the RSI not necessarily into a buy or sell signal, but into a very strong filter, and that is understanding how failure swings work in the market. Now, I've only got one here that shows you a reversal to the downside, but this is the point that I'm trying to make here. You can see where our high is here in the price action. Again, this is on the daily time frame of the euro dollar. And you can see where this swing point is down here. Now, if we extend a line across there, what you can see here, people would normally look for a break of structure to then either get short or looking to make a trading decision. But look at this here. This is where this failure swing concept in the RSI really works very, very well indeed. You get a break of that swing point here. Well, that ties into this swing low in the price action here. But we didn't actually get a break of that swing low down here over here when we got it in the RSI. That gives you a cue to look for shorting opportunities, and look at the advantage of using the RSI in that capacity. A really beautiful shorting opportunity is present there. Now, this is a daily time frame, but if you use that as a filter to say, okay, we've just broken this failure swing here, move to the downside, we've got some downside momentum here, I'm going to go to a shorter time frame now, and I'm only going to look for shorts. Yeah, so you take whatever concept, whatever strategy you've got, and you just look for shorting opportunities based on that as a filter. Very, very powerful. And that's got nothing to do with divergence. It's just using the indicator in its truest sense, using its understanding of how it's measuring that there's more downside momentum, or there's more momentum in the market that's going to bring us to the downside. And rather than waiting for a break of this structure down here, you can actually get a heads up and get a really nice entry on a short that's going to give you something. I mean, it's not an exit strategy in itself, but the point is, I'm showing you in a very intelligent way of actually using the indicator. Next one, focusing better quality support and resistance. This again ties into the same concept, but look at this. We've got a very meaningful downtrend here. We've got a beautiful resistance trend line that is painted in. Never forget that resistance trend lines are always painted above the channels, above the price action, not below. In a bullish market, you would always be support underneath. In a bearish market, you'd be resistance above. But look at this, this is really interesting. The same concept can be found in the RSI as it's moving down here. But look at this area here. Once we break the trend line there, we've still not broken any structural point of the resistance trend line in the price action as yet, but this is telling you that we've broken the trend line here. There's a lot of bullish momentum there. You don't see that. You'd actually probably be waiting for a break of, and you'd be looking to get involved in the market much higher up here once you've probably broken this swing high here. You don't need to do that because there's so much bullish momentum here. It's not overbought, yeah? So we're not at the peak, but it's showing you. And what that is there, that is that change in the rate of change. That's what that's showing you, and that's where you get that strong move in momentum. You don't get that in many other indicators. That's why it's such a very, very strong component, as you can see in this chart here. And finally, when to stay out. Now, this is a real example from this week that I used in my own trading. And this is the pound against the Swiss franc. It's a market I'm really actively involved in at the moment. And this is exactly the same kind of a principle here. You can see this is where you can use the indicators to basically tell you to stay out. So from a short-term intraday trading point of view, this is a 1 hour time frame, and you can see as the market starts to push up here, if you were a counter trend trader, you'd be looking for shorting opportunities, and you'd look at that and you'd say, okay, well, we've not broken this structural high here, so I'm going to enter into a frame of mind where I'm going to look for shorts. And then what happens, you just get eaten alive as the market starts to pump higher and higher. That's really, really difficult. Once you're then locked into that cycle, you'll harvest back a lot of your profits that you've made. But look at what the RSI has done here. The market here, as the market pushes higher and higher, we've failed to take out this swing high here, but look at the RSI. Easily broken that structural high in the RSI, showing you how strong momentum in this move currently is. That can tell you, okay, if you can't get long, don't short. Stay out of those shorts. I cannot tell you how much money that is going to save you, and that affects your bottom line. This is just intelligent understanding of how to actually use the indicator. It's really, really, really amazing. So there's a few things that we should consider when dealing with the RSI. It was built by James Wells Wilder. We're not going to go into all the basic history of that. You can dig around that on the internet or buy the books and stuff like that if you really want to. But what's important to understand with James Wells Wilder is that all of this stuff was done in the 70s when computers were not quite as good as they were now. So RSI was designed primarily for the daily time frame. And that means that if you're going to put it onto an intraday time frame, you've got to bear in mind where it was historically originally built from, daily time frames. So there's always going to be more meaningful on those bigger picture timeframes than it is on a intraday timeframe. You can use it, but you've always got to bear in mind. And use that daily timeframe as a line in the sand for how you're going to start to use the RSI. And then once you're practiced at it and you get better at it, you can then start to take it down to a faster timeframe. But it was designed for the daily timeframe. Use it as part of your strategy, not as a system in itself. I do think that is a very, very valid point. It's doing is just a tool that's showing you momentum, and you're using that momentum knowledge in an intelligent way and coupling it with your price action as well. In itself, if you're just going to try and trade divergences, I honestly think that you're going to struggle in the long run, because you'll find too many instances where it works and then it stops working altogether. It's one of the few indicators that the professional industry use. RSI is like Photoshop. It's a benchmark in the industry. It's like a 200-day simple moving average. It's used by all of the professionals. Just think about that. There's a reason why they decided to use this as a measurement of understanding momentum in the price action, because it does the job really well. And if the professionals use it, certainly you should consider using it as well, and keep it nice and simple. Understand how to measure momentum properly. Those charts that I showed you before, that basic concept of understanding how the RSI is measuring the rate of change and how we use that to say, okay, this is where momentum is strong and this is where momentum is starting to fade off a little bit. Understanding that concept will give me a really good gateway into getting more from the indicator. And finally, just remember, more than anything else, remember it's just a tool. It's just a tool out of all of the different technical indicators that you get access to. They are not complete and they are not perfect in and of themselves. They are just tools. So bear that in mind. Okay, we covered a lot. We covered a lot today. So yeah, that's everything we've got for today. Don't forget that $299 code if you want to get involved in a two-step. It is a good offer to take you into the weekend, and it'll be Black Friday next Friday as well. We've got an amazing offer, so we don't forget to pay attention to your emails, and we will make sure that you get easy access to the Black Friday offer that we've got coming next week. Other than that, have a fantastic weekend. Thank you very much for your company, and we will see you all next week.